In this video, I'm going to discuss the accounting related to stockholders' equity. And stockholders' equity often can be referred to as the capital of a company or the owner's equity, different ways of naming it. But this is the amount related to any contributed capital. In other words, investments by stockholders, plus any earned monies by the company that have been retained. Because the company, as it earns money, could also choose to distribute those monies as a dividend, right? So what we refer to as stockholders' equity is both the combination of what has been contributed from the investors plus what the company has earned and retained in earnings. So before I go into details of stockholders' equity and how we account for it, let's talk a little bit about the choice of organizational structure or business structure that a business person can choose. At one end of the structure that can be chosen, and the simplest of them all, is the sole proprietorship. And I'm sorry, I always have a hard time with that word. So if you are a person that's starting out a business, usually this is the simplest form of structuring your organization. You are the owner. You're in full control over what happens in the company. You don't have anybody else as owner in this company. So that's the easiest one of them all, and that's an option. Usually, companies when they begin, or people when they start a business, they start in that form. Another possibility is to form a partnership where you have 2 or 3 individuals that are the owners of the company. And then at the other extreme is the corporation. This is what we're going to be focusing on right here. And there's a lot of reasons why the corporate structure is a preferred structure for businesses. And we'll talk about that a little bit. Well, actually, let's just talk about it right now. So I'll address these in a minute. This is just simply the type of corporation that you can do. But the advantages of incorporating versus having these other business structures, okay? The advantages of incorporating, and this is probably the big hitter here, is the ease at which you can raise large amounts of capital. Okay, when a company is set up as a corporation, you are able to issue shares. You're able to sell stock, and people can buy the stock. And the transfer, and this is key, the transfer of that ownership in that business is really easy. In other words, if I have a share of a particular company, IBM or whatever, I can easily sell it to somebody else. And whoever owns that share doesn't directly affect how the operations of the business happen. And that's a big thing, because through the corporate structure, you can separate who is running the business versus who is owning the business. So the stockholders own the business, but they indirectly manage by choosing or voting the board of directors. And then the board of directors choose management, right? That's in general how it works. Unless you have like a very large stockholder in a company, which occurs as well, then that person also could have a bigger say. But usually the nice thing about the corporate structure is that because we can have such easy transfer of ownership through the stock, it allows us to raise capital in large amounts by issuing stock to the public, right? You can issue common stock or preferred stock, and we'll talk about these a little bit here further down. But that's a big thing. The other big thing of the corporate structure, and by the way, let me compare to the sole proprietorship or the partnership. Under these scenarios, you're keeping control or ownership of the company very close. So to raise capital, it's not as easy, right? Because it's your money or the money of the partners. Ownership is not allowed to others besides you. Well, I mean, it can be, but the idea is that you keep in tight control over who owns the company. Whereas with the corporate structure, the ownership could be a whole bunch of people in the public. Okay, and we'll talk about that in a minute here. Second advantage of the corporation, big advantage, is that the corporation itself is a separate legal entity, and the corporation transacts independent of the stockholders. So the corporation, signs contracts uh, and on its own without necessarily the name of the stockholders, and that's a big thing. It being a separate legal structure, it's a big thing because number one, that limits liability to the owners. If for some reason something occurs and the corporation is sued, well, the corporation can lose up to the amount in that corporation, not necessarily additional amounts, for example, owned by the owners, other things owned by the owners. So you're limited as an investor, you're limited to your to your investment in terms of your potential liability. And that's a big thing. In a sole proprietorship, that might be harder because if the corporation gets sued, you as the sole proprietorship, you might also be liable apart from the assets that the business owns. With the corporation, the amount that can be lost is up to your investment. That's it. This structure, the fact that it's a separate legal entity from the owners, also is good in the sense that it allows the corporation to continue to exist, independent of which owners come in, which managers come in and go out. The corporation itself continues indefinitely until it's chosen to be closed, but it is not tied to the life of the owners or the managers or other things like that. So these are some big advantages of setting up as a corporation, as choosing the structure as a corporation. A couple of notes here. So the bigger companies are going to be your C corps, and this is the traditional corporation. This is where once a corporation makes money, generates profits, the corporation pays a tax on those profits, and then the corporation distributes dividends to owners, and then the owners also pay taxes on those distributions. So traditionally, the C corporation ends up having a double taxation. Later on, for smaller type corporations, the S corp was developed, and this is mainly for smaller corporations. But I mean, there's still some large ones out there. And basically, the corporation is not taxed, just like like in the C corp, the corporation pays taxes on the profits, not the S corp. The S corp itself is not taxed, but then all the profits go to the stockholders and then are taxed at the personal level. So with the S corp setup, you only have one level of taxation, and that's sometimes what people choose these type of corporations. Usually, these are for smaller companies, like less than 100 employees or something like that. But your big corporations are the ones that are going to be in the C corp category. Now, even though the sole proprietorship and the partnerships are more, you see more of these setups in frequency. In other words, there's more companies set up as sole proprietorships. The smaller frequency is corporations, but even though they're smaller in frequency, the corporations are the ones that have the largest revenues, the largest profits, assets, etc., of other business structures. So for the larger companies, this is how it's going to work with the corporate structure, given these advantages right here, right? Now, if you do set up your company as a corporation and you do issue shares to the public to raise capital, as we're saying right here, then at that point, that company here on this little side note says that's a public company. And if it's traded on the stock exchanges, New York Stock Exchange or such, then we refer to this as a public company. Now, be very careful. Okay, some of you may think of the phrasing public company as like a government entity, and that's not the case. When we refer to public company here, what we're saying is that the shares of this company are owned by the public, right? Publicly traded. And once that occurs, then the company falls under the SEC, the Securities and Exchange Commission's requirements, and hence they have to follow U.S. GAAP, okay, U.S. Generally Accepted Accounting Principles. This is the case, when a company first issues an offering, the initial public offering, when they first issue stock. And there's some requirements. Once a company is going to issue stock to the public, there's a lot of reporting requirements that need to take place before they can actually raise that capital. Their financial statements need to get audited. In other words, they got to follow all those SEC requirements because they're going to become a public company, publicly traded company. Now, lately, there's been talk about some special purpose acquisition companies, sometimes referred to as blank check companies. These are just ways in which other people have found it easy to go raise capital through the corporate structure. So without going too much into detail, think of the IPO as the high quality form of you issuing financial statements and going public and selling stock. Okay, whereas this special purpose acquisition company, these are groups of investors that create the SPA, and then they merge with a company that's starting out, and through that merge, that company that's starting out can raise capital. And some of the advantages, and I don't know if it's an advantage, honestly, but some of the things that make it easier to raise capital through the blank check company is that that company that's starting out and raising capital through the SPA has less stringent reporting requirements than that company that has to go through the formal IPO process. So be careful with that, because in an initial public offering, this is the company itself, the corporation itself, selling shares to the public to try to raise capital. And because of that, there's the SEC reporting requirements that are very strict and have to be complied with. Whereas this has become a way where companies are finding a way to merge with these blank check companies that have the funding, and it allows them to raise capital, but the reporting requirements are not as stringent. So these are riskier type of companies to invest in. Okay? All right, so that gives us an overview of the business structure, the choices that managers or owners make. And our focus, again, is going to be on the corporate structure. What we're going to talk about right here and further down is about the corporate structure. All right, so next thing we're going to talk about. So let's discuss the contributed capital component right here. And that's what this is, okay? So if you sell stock, there's some rights that carry with that stock, right? So what are some of those rights? And we're talking about common stock or preferred stock. So, but let's go ahead. So one of the things that you as a stockholder are entitled to is profits, right? And as the corporation generates revenue, generates profitability, you, the owner, will get a share of that based on the number of shares that you own, based on the percentage ownership you have. Now, the way you get that profit, we said earlier, is in the form of dividends, right? When a corporation issues the dividends, the profits, it goes to the stockholders in dividends. And we'll have a video later on discussing how to account for dividends. There's different types of dividends. The more traditional dividends are your cash dividends, but you could also have stock dividends, property dividends. So watch that video as well. The other right that comes with ownership is the right of management. But let's be very careful. This is indirectly managing the corporation. And the reason I say that is because you, as the stockholder, you're going to be voting for the directors, the board of directors. So you have control over that. And then the board of directors are going to be choosing who the managers are. So in one way, you are indirectly managing this company. But that, like I mentioned earlier, the fact that you are not necessarily directly managing, it's what allows this company to exist, to continue to exist, even after you are gone or you sell your shares, right? And this is what I mentioned right here as a benefit to a corporation. Think about the sole proprietorship here, which is not what we're focusing on, but just so you think about that. Under the sole proprietorship, once the owner passes, for example, that's it. The corporation ceases to exist because that is the main person running the show, right? In a corporation, even if some of these owners leave or pass or whatever the case may be, the shares would be transferred or sold to somebody else. So that corporation continues to exist. So that's kind of the idea here, that you're doing things indirectly as a shareholder. The other thing that you're entitled to or have a right to is corporate assets upon liquidation. If the corporation ceases to exist because it's no longer profitable, then you as a stockholder have a claim to those assets. Now, your claim is one that's sort of a residual interest in the corporation. And what that means is that, first of all, it's not guaranteed that you're going to get anything, right? If the corporation is not doing well, most likely, you're not going to receive anything, because we first pay out liabilities. So anything that's owed is paid out with the assets of the company. And then once those liabilities are paid off, any residual amounts are paid off to preferred stockholders and eventually to common stockholders. Now, keep in mind that if a corporation is not doing well, they're probably going to have less assets than normally, right? So when you liquidate as a stockholder, you very likely will not get much. Stockholder right, the preemptive right, this one allows you to participate anytime there's a new issuance of shares. So if you're a stockholder, you own 10%, let's say, and the company issues a secondary offering or some other offering of shares, well, you would be allowed to buy into those shares in order for you to maintain your 10% ownership. That's a right you have prior to anybody else being able to buy them. Now, you can choose not to buy it, but that's a right that you would have as a stockholder. Okay, some other attributes of contributed capital. And some of these other attributes that I'm going to describe here refer to attributes related to preferred stock. So for example, this cumulative versus non-cumulative. This is with respect to dividends. Usually preferred stock has a stated amount of dividend that it says will be paid out. And if that's the case, every year that preferred stockholder is going to receive $1 per share, whatever the case may be. It's not guaranteed though, okay? Because if the company doesn't have cash to pay out dividends, then even that preferred stockholder whose certificate says that they will get $1 per share, maybe in 1 year they will not receive it, and that's okay. Now, if they do not receive it, and then the following year dividends are paid, the question is, should that preferred stockholder get not just the $1 for the current year, but also the $1 from the previous year? And that all relates to whether that preferred stock is cumulative versus non-cumulative. So if the attribute of the preferred stock is that it's cumulative, then yes, that $1 from the past, those dividends in arrears is what we would call them, those would have to be paid out first before anybody else. So in that case, you would pay $2 of dividends, $1 for the previous year and then $1 for the current year. If it's non-cumulative, any dividends in arrears are lost. Okay, so that's kind of the thing. So obviously having a cumulative preferred stock is better. Another thing that may be related to preferred stock or even some types of common stock is whether it's actually I meant for voting. Let's talk about voting since I mentioned that. Okay, so some types of certificates have voting rights and others don't. So depending on how the corporation or the owners or the current owners are wanting to raise capital, they could issue voting versus non-voting stock. Sometimes corporations have a group of owners, managers that they like, that they want to keep control over, so they issue non-voting stock to raise capital, but with the intention that any future owners are not going to have a say in terms of how it's managed. And this all depends on where you're at in your corporation. Now, here's one related to preferred stock. Is that preferred stock participating versus non-participating? Again, this is with respect to profits. So if you recall with the cumulative versus non-cumulative conversation, the typical preferred stock has a stated dividend, right? So it is stated that you get $1 per preferred stock share every year, okay, to keep it simple here. So Once you get your dollar, let's say a company has a really good year and they have high profits. Once you get your dollar, are you able to participate in additional distributions? And it all depends on whether that certificate is participating or not. If it is a participating preferred stock, then you would be able to receive additional amounts apart from the dollar. In other words, you'll be able to participate in those additional profits besides the dollar that you were given. Versus non-participating, you just get your dollar and that's it, dollar per share. All right, other attributes that we need to discuss here. The bond can be callable. In other words, I'm sorry, not the bond. The reason that I said bond is because usually callable features related to a bond or like a debt type of instrument. But you have these kind of instruments here that are redeemable or callable. So if you have a stock certificate that falls under that criteria, here's what I want you to think about. If the corporation is able to call that bond, right? Then it's seeming more like it. And how do I say this? Let me start that again. If it's a callable bond, okay, so the corporation can call it, right, and buy it back from the stockholders. If it's a redeemable stock, the stockholder can actually redeem the stock at any time. In other words, get their money. So one is the corporation can call it. In other words, they can buy it back from the stockholders. And then the other side of it is the stockholder instead could choose to redeem the stock and get their money back from the corporation. In other words, they can choose to sell it back to the corporation. So when this is the case, okay, whenever you have a redeemable stock, you got to be really careful because in accounting, I've often said it's substance over form, right? So even if you call this a stock in form, you call it a stock, the fact that it's redeemable, it really sounds more in substance like a liability, right? If the holder of that instrument, that financial instrument, is able to have the corporation pay them back at any time, then that sounds like a liability. So for these types of certificates, and let's call them financial instruments to be more careful. For these types of financial instruments called redeemable stocks, we report them not as a owner's equity, but instead this midsection called temporary equity. And we put this right between the owner's equity section of the balance sheet and the liability section of the balance sheet. It's a temporary equity instrument so that we inform the public or stockholders that, hey, there is this potential that these certificates may be redeemed and the corporation may have to pay on them, right? And that's why it goes into this temporary equity section. All right. Lastly, convertible stock. So there could be stock, like preferred stock, that has the option to convert it to common stock. So that's also an attribute that it could have. And in general, okay, I want you to just think business here. In general, anything that I say here that seems like a positive thing versus another, for example, the typical person would prefer to have cumulative shares versus none, right? It's better to have cumulative. It's better to have a participating stock than non-participating. Anything that you would consider a positive, okay? It's not like you're going to choose and say, you know what, I'm just going to get this share and I'm going to be better off. No, the market typically adjusts to all these positive versus non-positive things, if you want to think of it that way. So if you have, let's say a company has both cumulative and non-cumulative stock, and everything else is the same. Well, naturally, the cumulative shares are going to probably be trading at a higher amount than the non-cumulative shares. So, in other words, in one way or another, you're going to pay for that additional positive feature. It's not like you're getting a benefit for free. So if you think participating is better, probably the participating shares are going to be trading at a higher amount than the non-participating. Okay, so keep that in mind as a general business thing. The things that are positive usually have a premium in terms of cost to them. All right, last couple things I want to mention here. The first one is, So how do we value these transactions? And these are pretty straightforward. Um, the valuation. So there's usually a par value attached to the stock. So we first assign whatever amount so if we sell the shares for cash, right? And we're going to sell them for as much as people are going to pay us. So if we sell for cash and we sell each share for an amount that's higher than the par value, then we put the amount related to the par value there, and then any remaining amounts go to additional paid-in capital. So let me give you an example. Hold on. So assume that I issue 100 shares of $5 par stock for $13 per share. Okay, so and I haven't talked about this par idea, but let's just talk about it real quick. Each share in general has a value attached to it, a par value, meaning it has something to do with the minimum legal capitalization that a company should have in their balance sheet. And I'm not going to get into that discussion, but traditionally that's what it's meant. So in other words, without you taking too much into this, if I sell 100 shares and I sell them for $13 per share, then I'm going to receive cash of $1,300, right? Now, I have to separate the par amount from any additional amount. So the par amount for 100 shares is 100 times 5. So that's my common stock par value right here. And then the additional amounts are put into additional paid-in capital. So that's pretty straightforward. So without getting much into it, this amount of par value traditionally has meant something related to the corporation needs to have at least $500 in cash to meet that minimum legal capital. But that's not something that the case nowadays, and it's just kind of confusing nowadays, honestly, as to why. Because nowadays corporations will designate the par value as a penny, or sometimes they'll even put non-par value stock. Okay, so it gets weird, but it started out as such. But we continue using it, and there's still stock certificates out there, old ones with par value, so we have to account for them that way. So when you issue stock for cash, then you use the cash value, because technically the cash value is the fair market value. Okay, that cash, whatever value it has, that's the fair market value of that transaction. So those are straightforward. If instead you issue stock for other things, okay, it's non-cash. What are other things? Maybe you provide a service to a company, and instead of them paying you cash, they pay you in the form of stock. That could be a possibility. Or instead of an investor providing cash, they bring in machinery that's needed. And in bringing in that machinery, they are given stock instead of cash. So in those cases, how do you determine the value of the exchange? Here it was easy. If I sell 100 shares and people give me $13, then the value of the exchange is $1,300, right? Because it is well supported that each dollar is worth $1. I mean, that sounds kind of obvious. Now here, in this case, let's say I'm doing the example of the machinery. Somebody brings in machinery and we give them stock. How do you determine the worth of that? Okay, you use the fair market value of the stock or the asset received. Okay, either one. You determine what the worth of the stock is. That's one possible valuation metric. Or you determine the worth, how much that asset received, that machine is worth. So which one do you choose? Well, you choose the one that is better supported, the one that is more evident. So for example, if the company is publicly traded in a stock exchange, then that would be a good measure, because that's a whole bunch of people buying and selling the stock. So we could actually determine the value of the exchange simply based on the number of shares that we're going to hand out and the value per share. Okay, so that's one potential metric that is well supported. And if that were the case, if it's a publicly traded company, I would probably go in that direction. If it's not, let's say those stocks are not traded in an exchange, then at that point, it's harder to determine what the worth of those stocks are, right? It might be easier to get an appraisal of what that machinery is worth. And if we could get an appraiser to do that or something similar, then at that point we say, okay, you know what? The value of the exchange is not necessarily going to be whatever worth we assign to the stock, it's whatever worth we assign to the asset received. And this rule applies in general everywhere in accounting, okay? Whenever we have to decide the value of an exchange that is not cash related, okay, we always have to choose the one that is more evident. So keep that in mind. And that's the way we would do this transaction. Choose the one that is more evident. Okay, last little thing here. If you issue stock, usually there's stock issuance costs involved, right? There's the underwriters, there's the accountants, the attorneys, all that. Those are costs related to the issuance, to you being able to issue that stock. So the way we account for that is we simply reduce it from the proceeds. Okay, in the example here, I say I issue $100 in stock and incur a stock issuance cost of $5. I don't even account for it. It just gets netted out of there. So for some reason, we would have done it here as well, that we had stock issuance cost of $5. Well, we would have received $12.95. Okay, common stock would still be $500, but then a PIK would be $7.95. In other words, you take the $5 out of here and the $5 out of there, and you don't even account for it. You just record the net proceeds, like in here. Even though we issued $100 of stock, I record the net proceeds of $95. Okay. All right. This concludes the video on stockholders' equity. A lot of things were discussed here. Make sure you watch the video on accounting for dividends as well.